Imagine three heavy levers on a wall. One is labeled interest rates, one is labeled tariffs, one is labeled prices. You can only hold two steady. The third always moves. That's the game of money policy. Someone always pays. The only question is who. Right now, rates are being pulled down. That means either prices rise or tariffs get cut. There's no version where all three stay quiet. Which lever ends up moving? And more importantly, which lever moves the ground under your feet? If you understand the game, you stop being surprised when headlines swing. You start seeing the cost before it lands, and you can build a plan that bends without breaking. On the passive path, we map out those costs, not as theory, but as signals that tell you what to do with your money next week, next month, and next year. The recent cut was small. It was called preventive, a vitamin, not morphine, but the numbers underneath don't look like a healthy body. GDP looks fine on paper. But peel back the layers and you see why it only looks fine. Imports fell, and that trick made the spreadsheet climb even while households pulled back. Consumers, the real engine, cooled down, jobs data got revised lower, even negative in a month, and yet the headline kept smiling. That's the danger of living on headlines. They give you a quick story, not the full story. If you only hear the headline, you're playing with foggy glasses. If you see the three levers, you're playing with a clear map. So let's take the transcript's message and translate it into your wallet. Not in theory, but in daily impact. Interest rates touch your mortgage, your credit cards, your business borrowing. They inflate or deflate the price of your stocks. Tariffs sit quietly in the background until you check out at the store, until your company's supply chain pays extra, until margins thin. Prices, the third lever, chew your paycheck. Your real wages shrink. Your savings erode. Your investments wobble because multiples shift. You can't escape the three levers. You can only understand who's paying this round. So here's the signal. The cut was called a vitamin, a gentle step to keep the body well. But the patient is showing tired legs. A vitamin doesn't cure fatigue. And if the fatigue grows, you're going to see bigger medicine later. The question for you is simple. Do you build your plan as if this is a small bump or as if this is the start of a long trail? Next, we'll test GDP itself. Why up doesn't always mean strong. DP growth looks strong at first glance, but strength on paper is not the same as strength in life. When imports fall, the GDP formula adds points. The country buys less from abroad and the math says growth, but you feel it differently. Your shopping cart is lighter. Your travel plans shrink. Your choices narrow. Imagine a family in a suburban town. They stop buying imported goods first. Cheaper shirts instead of branded ones. Canned foods instead of fresh fruit from overseas. The national account says growth, but the kitchen feels smaller. Next, they cut back on trips. Less flying, more driving, more staying home. Again, GDP shows savings, but the family feels squeezed. Later, they cut streaming subscriptions. A few dollars here, a few dollars there. The chart looks stable, but their evenings feel thinner. That is the illusion. GDP rises when imports drop, yet the lived experience is contraction. This is why chasing headlines can blind you. A nation that consumes less looks stronger on paper, even when households weaken. Your real test is not the GDP print. It is the weight of your shopping bag. It is the energy of your paycheck. It is the security of your work. The transcript's point was clear. Consumption has cooled. Imports fell, and the GDP headline masks that weakness. So the question becomes sharper. If the body is slowing, what does that mean for jobs? Because jobs are the bloodstream of the whole system. And once the bloodstream thins, the entire body shows the truth. The unemployment rate looks steady, but the way it is measured hides the truth. A person who gives up looking is not counted. A person who works 1 hour a week is counted as employed. A person who takes a temporary gig is considered secure. That is why the headline rate feels misleading. It shows stability when the foundation is shaking. The revisions told the real story. Non-farm payrolls were marked down. Even 1 month turned negative. The strength in the labor market softened quietly, out of sight. Picture a mid-career worker. He was laid off 6 months ago. His benefits ran out. He stopped filing applications because no one called back. The system erased him from the data. He is invisible to the unemployment rate. But his family feels the gap every day. That is how the bloodstream thins, not in headlines, but in kitchens, living rooms, and grocery aisles. The transcript pointed out that weakness. Revisions lower. negative prints, a softer picture than what the surface suggests. So ask this, if jobs are weaker than we thought, why describe the cut as a vitamin? Why not admit the patient is tired? Because markets respond differently to words than to deeds. And the deeds of the big players tell a separate story. It is not about what they say, it is about what they do with their money. And that is where the next signal comes from. The largest players in the market speak with two voices. One voice is for the public. The other voice is in their trades. A small, loud purchase can be staged for headlines. It catches attention, it looks like confidence, it pulls the crowd in. But behind the curtain, the real flow may be the opposite. Quiet, steady selling, moving out of positions, building ladders in bonds, preparing for a different outcome. Think of a neighbor who boasts about one winning stock. At a barbecue, he brags about doubling his money, but in his retirement account, he is down 20%. The story sounds strong, but the balance sheet is weak. The transcript warned about this trick. Watch net actions, not single trades. Count the money flows, not the sound bites. When you read about a famous investor buying, ask what they sold. Ask what they shifted in size. The truth hides in the quiet trades, not the public quotes. This skill changes the way you see markets. You stop chasing noise. You start measuring the sum. You become the adult in a room full of children clapping at a toy. So where does money actually run when the levers move? When one currency weakens, where does capital go for safety and yield? That answer points across the ocean, toward Japan. When US rates fall and Japan's rates rise, the flow of capital changes direction. Money searches for yield. Money searches for safety. The yen becomes stronger. Japanese stocks rise as investors move into that market. This is the reverse of the carry trade. For years, funds borrowed cheap in yen and invested elsewhere. When rates shift, that trade unwinds. Borrowers must repay in yen. The demand pushes the yen higher. Picture a global fund manager. He borrows in yen at low cost. He invests in US assets with higher returns. When US rates drop and Japan edges up, his math breaks. He scrambles to close the position. He buys yen back. That pressure fuels the rally. The transcript pointed out this path clearly. It is not just about US moves. It is about relative moves. When one door closes, another door opens. And right now, Japan's door may attract global capital. This is why watching only one country is dangerous. Markets are tied together. Currencies, bonds, and equities weave into one rope. If you tug on one end, the other side moves too. So the question shifts. What assets make sense when the rope tightens? Where do you place your bets when the flows are global, not local? That takes us into the buckets of assets. The choices that can either cushion you or cut you. Like reserves, sit on one side. They give you breathing space. They give you optionality. They let you act when others are frozen. Short-duration bonds belong here too. They earn a small yield. They protect against sudden shocks. They keep your powder dry. Then come the hedges, gold, silver, and Bitcoin. They act as shields when currencies wobble. They are not guarantees, but they provide protection against decay. Equities are the selective bucket. Not all stocks, not every index, picky choices. Quality businesses with real cash flow. Markets that gain from capital shifts, like Japan if the yen strengthens. On the other side stand bonds. Longer duration can pay, but timing hurts. If cuts are slow and inflation lingers, long bonds sting. If policy snaps, they can rally hard. The transcript pointed out this balance. It is not about loading into one side. It is about holding a barbell. One side safe, one side asymmetry. Nothing in the middle. Think of it as carrying weight, heavy on both ends, stable in the middle. That is how you keep balance when the ground shakes. But timing is the piece that breaks most investors. It is not the choice of asset. It is the trap of when you buy. And that is why the next lesson matters. Timing punishes more than selection. A good asset bought at the wrong time becomes a bad trade. A weak asset bought with patience can still turn into a gain. Slow cuts create traps. Markets expect rescue. Prices bounce, but earnings lag, and the second leg down arrives. This is why blind dip buying hurts. The first drop is not always the last. Often, it is just the opening act. Think of a trader who sells too soon. He panics on the first dip, then he buys back too fast. The second drop hits harder. He has no rules. He has only reaction, and the reaction costs him twice. The transcript warned about this danger. Volatility windows open when policy crawls instead of snaps. Patience matters more than bravery. Rules matter more than feelings. So how do you stay steady in those windows? By having a plan that is not about guessing bottoms. By holding a map that tells you where to stand no matter what the lever does. This is where the barbell strategy returns. We covered it before on the passive path. Now it deserves another look, because with the three-lever lens, the barbell takes on sharper meaning. The barbell is simple. One side holds safety. The other side holds controlled risk. The middle stays empty. On the safety side, keep 6 to 12 months of living costs. Add short-term bonds, keep liquidity you can touch quickly. This gives you time, it gives you calm, it lets you wait while others rush. On the other side, hold asymmetry. Small positions in assets with large potential. Themes that may benefit from policy shifts. Carefully sized. Rules set in advance. Losses capped. Upside uncapped. The middle is where most investors fail. Too much risk to be safe. Too little risk to win. Exposed on both ends, with no edge. This barbell was explained before on the passive path. Today it matters even more, because the three-lever system tells you when each side of the barbell gains weight. When rates cut slowly, safety must be heavier. When currencies wobble, hedges take their place. When flows move abroad, equity bets shift countries. The barbell bends with the levers, but it never breaks. The next piece is risk rules, because the best design fails if the pilot panics. Risk rules are the anchor. They keep you steady when screens flash red. They stop you from chasing when greed whispers. Start with position sizing. Decide how much of your portfolio each bucket can hold. Decide how much a single trade can lose without breaking your plan. Write it down. Follow it without exception. Next, set exits before entries. Place stop-loss levels. Place profit locks. Place cooling-off timers that stop you from re-entering too fast. The rule is simple. Decide when to leave before you walk in. Use a checklist for every decision. Which lever is moving? Who is paying the cost? What breaks my thesis if I am wrong? If you cannot answer, do not act. These rules are boring. They are quiet. They are the difference between surviving and disappearing. Without rules, you become the trader who wins once and loses twice. With rules, you become the investor who compounds slowly and never breaks. And the real edge is not in charts or forecasts. It is in your mindset, because the mind is the final lever. The borrower's delay is the first story. A business owner waits for lower rates. He holds off borrowing, but the cuts are slow. His runway shortens. His window closes. Waiting costs more than acting. The spreadsheet illusion is the second story. An index climbs. A headline says growth, but the family fridge is emptier. The shopping bag is lighter. The lived experience does not match the chart. The one-trade brag is the third story. A friend boasts about a single win. He made money on one stock, but his total account is shrinking. He counts the shiny coin, not the pile. Pride blinds him to loss. The vanishing worker is the fourth story. A man loses his job. He stops looking. The system stops counting him. He disappears from the numbers, but his bills still arrive. His absence weakens the hidden foundation. The carry unwind is the fifth story. Investors borrow cheap in yen. They pour money abroad. When rates shift, the trade reverses. They rush back to yen. The demand strengthens it. Japan gains while others stumble. These stories are signals. They remind you that wealth is not only in charts, it is in behavior. It is in discipline. It is in seeing what the surface hides. The final step is turning these signals into action, not someday. This week, this month, steps you can take with your own hands. Each month, review the three levers, check the direction of rates, check tariff news, check inflation signals, mark who is paying the cost. Each week, sort your watch list, rank assets by exposure to the moving lever, move safety higher when the body looks weak, shift risk when the window opens. Each day, keep a one-page journal. Write your plan, write your risk, write your exit lines. Mark your emotions, fear, greed, calm. This record protects you from forgetting your own mind. Then choose 3 steps to act on. Map which lever is paying right now. Refill your safety side with cash and short-term bonds. Trim or add to your asymmetry side depending on flows. Finally, set one rule you will not break this month. It could be no trade without an exit. It could be no position over 5%. It could be no re-entry in less than 7 days. One rule, held with discipline. These steps are not theory. They are habits. And habits are how wealth is built in silence. The passive path is about making those habits clear. It is about walking with a plan when the world shakes. It is about bending without breaking. Picture the 3 levers again. Rates, tariffs, prices. 2 stay pinned. 1 moves. You do not get to fix all 3. You do not get to control the wall. But you do get to choose where you stand when the lever swings. That choice is your edge. That choice is your path. Follow it with patience. Follow it with rules. Follow it with balance. And you will not just survive the swings. You will grow through them.